Welcome back to Investing Talk Podcast.
Today we are tackling the big one, the absolute king of the hill. We are talking about Netflix. But listen, if you think this is just another conversation about subscriber numbers,
Right.
or, which show is trending in the top 10 this week, you need to reset your expectations completely.
Okay. We do have a massive stack of research to get through today. Q3 earnings reports, some really interesting technical charts, sentiment analysis from Alpha Vantage, and even some legal briefs.
And the picture is massive.
It is.
It is. This isn't just about the streaming wars anymore. We are potentially looking at the birth of a genuine media monopoly.
Right.
The stakes for 2026 are absolute insanity because of one massive looming narrative: the $82.7 billion acquisition of Warner Bros. Discovery.
82. Wow. As usual, before we start, subscribe, like, and comment to this video to support the show. But I have to stop you right there.
Go ahead.
You just dropped that number, 82 billion, like it's pocket change. I mean, that is a GDP-sized number.
It is massive, and that's the so what for today. Look, Netflix isn't just trying to raise prices on you anymore.
No.
They are trying to buy the competition outright. We are talking about a super app potential here.
A super app.
Imagine a platform that holds Netflix's entire library, plus Harry Potter, plus the entire DC universe, plus HBO's catalog. They are trying to build an intellectual property fortress that no one can breach.
See, that is where I have to jump in with some immediate skepticism.
Okay.
I hear super app and IP fortress, and my brain hears integration nightmare. A deal north of $80 billion brings a mountain of debt. It brings regulators sniffing around every single corner. And, I mean, historically, these mega mergers, think AOL Time Warner, they're messy.
They can be.
So is this real growth we're looking at for 2026? Or is this just massive financial engineering to hide that they've run out of new people to sign up?
That is the multi-billion-dollar question, right? Is this a desperate grab, or is it the final checkmate? To answer that, we can't just look at the rumors. We have to look at the machine itself.
Exactly. So let's strip away the Hollywood gossip for a second and look at the actual engine. Let's pivot to the fundamentals.
Right. So we have the Q3 2025 numbers in front of us, and honestly, for a company this mature, they are shocking.
How so?
Revenue is up 17% year over year.
17%.
Usually when you get to Netflix's size, you're happy with single digits, you're happy to just match inflation, but no, they are posting 17%.
That is a big number. But where is it coming from? The U.S. market feels pretty tapped out. I mean, everyone I know has Netflix.
It's a mix, but the real volume story is in the East. It's the Asia-Pacific region. APAC revenues surged 21%. That is where the eyeballs are coming from. The North American market is saturated, we know that, but Asia is just exploding for them.
Okay, but let's look at the guidance. They're guiding full year 2025 revenue at, what, roughly 43 to 45 billion?
Right.
That implies about 16% growth overall. My question is sustainability. Can a company this big really keep growing at 16% annually? Or is this just a blip before the plateau?
Well, look at the efficiency. This is what I call the cash cannon. Their operating margins are hitting 29% for 2025.
29.
And the goalpost is moving even further. They are aiming for 33.3% by 2027.
Hold on, let's pause there for a second. For anyone listening who doesn't stare at balance sheets all day, break down operating margin. Why does that 33% number matter so much?
Sure, think of it this way. For every single dollar Netflix earns from your subscription, after they pay for servers, employees, show production, all of it, they get to keep 33 cents of pure profit before taxes.
That's a lot.
In the media world, that is unheard of. Disney or Paramount, they struggle to get margins half that size. It's software-level margins for a media company.
That is impressive, I'll grant you that. But margins are one thing, actual cash in the bank is another.
And that's where the story gets really interesting. Free cash flow, the actual cold, hard cash they can use to do things like, buy Warner Bros.
Right.
Is projected at $8 to $9 billion for 2025.
Yeah.
That is their war chest.
It is a big war chest, but let's look at the other side of the ledger. They are burning the furniture to keep the house warm.
I mean,
Look at the content spend. Nearly $18 billion.
yeah.
They are burning cash to make cash. It feels like a treadmill that's moving faster and faster. If they stop spending that $18 billion, the subscribers leave, and that free cash flow, it just evaporates.
That's true, but you have to look at what that spend is buying. It's building the moat, the network effect.
Okay.
And you have to look at the ad tier. They have 94 million monthly active users specifically on the ad tier now.
Yeah.
That is a massive audience they're monetizing twice.
94 million. That is a lot of eyeballs.
It is. And the content drivers are creating what we call high switching costs. If you want to watch adolescents or K-pop Demon Hunters, you have to have Netflix. You can't get it on Disney+.
Those shows are huge.
Yeah.
But it's not just scripted stuff anymore, right?
No, and this is the strategic shift. They are locking in live events. They've got the NFL Christmas 2025 game. They've got the partnership with WWE Raw.
The WWE deal is interesting because that locks in advertisers. You know exactly who is watching wrestling.
Exactly. It turns Netflix from a binge and cancel utility into a must-have weekly habit. If you miss Raw, you're out of the loop. That's the competitive moat.
All right, so the engine's running hot. Let's pivot to the charts and see if the price matches this story.
Let's do it.
Looking at the technicals, the stock is currently in what we'd call oversold territory. I'm looking at the RSI, the Relative Strength Index, and it's sitting right around 29. Now, for our listeners, anything under 30 usually suggests the selling has been too aggressive, right?
That's exactly right. I interpret that as exhausted bears. The sellers are just tired.
Okay.
We've seen some dap downs recently, sure, but that's entirely fear-based. It's about the uncertainty of the Warner deal. The market hates uncertainty. But when that RSI hits 29, it means there's almost nobody left to sell.
There is a massive disparity in where analysts think this thing is going, though. We've got some bullish models suggesting an upside to, what, $1,360?
Which is astronomical.
Right. But then you have other models looking at the $80 to $90 range as, like, an entry point.
It's volatile. And that disparity tells you the market is trying to price in a merger that hasn't happened yet. If the deal goes through, you're looking at that higher tier. If it falls apart, you're looking at the fundamentals. But look at the institutional flow.
You mean the smart money, the big funds?
Exactly. Look at the call options volume for January 2026. It is high. A call option is basically a bet that the price will go up.
So institutions are betting on a rise.
They are piling into these bets for next year. They are positioning themselves for the acquisition to actually close. They're looking past this short-term dip.
That is the optimistic view. But the skeptic in me looks at the MACD.
The moving average convergence divergence.
Right. And I see a risk of a bullish crossover being a false signal. If the deal hits a regulatory wall, if the FTC steps in and says, no deal, all those call options are going to zero.
That is the risk. The chart can tell you momentum, but it can't predict the Department of Justice.
Fair point. So let's look at what the street is actually feeling.
Let's look at the psychology. Sentiment is tricky, but when we run the quantitative scoring, it gets clearer.
I ran the numbers through Alpha Vantage sentiment analysis. The weighted sentiment is coming back as bullish. Specifically, out of the 5 major headlines dominating the news right now, 3 are definitively positive.
And it's not just fluff pieces. We have real news catalysts. Look at the Golden Globes.
They swept them.
Absolutely swept them. 7 wins. And they specifically cited adolescents.
I keep hearing about that show. Why does an award show matter for the stock price, though? I mean, do investors really care about trophies?
It matters for the talent flywheel. If Netflix wins awards, the best directors want to work there. It signals that their content quality is keeping up with the quantity. It's not just flooding the zone with mediocrity.
So it attracts talent, which makes better content, which keeps people subscribed.
Precisely.
What are the banks saying?
HSBC initiated a buy. Wedbush is maintaining an outperform. The consensus seems to be that the fears around the Warner takeover are, well, overblown. They think the market is panicking.
Well, let's address the elephant in the room. The speculative rumor mill is churning out one thing. The Warner Bros. Discovery acquisition. $82.7 billion.
It is the narrative for 2026. And look at what CEO Ted Sarandos is doing. He's out there committing to 45-day theatrical windows.
Which is a huge pivot for them. Netflix used to hate theaters.
He has to do it. He's doing it to appease the Warner talent.
Yeah.
He's trying to tell directors, if we buy your studio, your movie will still be in cinemas. It's an aggressive integration play. He's smoothing the runway before the plane even lands.
It sounds like he's desperate to close the deal. But it's time for a reality check. Here is the bear case. Because it's not all Golden Globes and growing margins.
Lay it on me.
First up, the deal risk. The Paramount lawsuit. This isn't just a nuisance, it's a proxy fight. There are legal hurdles that could significantly delay that Q3 2026 closing.
Legal hurdles are part of the game, though.
It is, but it creates uncertainty. And that uncertainty, combined with the debt load, they are taking on Warner's baggage, plus paying that $82 billion price tag. The sentiment score attached to that lawsuit news is a negative 0.206. That is somewhat bearish, bordering on ugly.
That is a fair concern. The balance sheet will get heavy. They won't be that lean, mean software company anymore.
And then there is the competition and valuation. Compare them to Disney. Disney is diversified parks, cruises, merchandise. If streaming slows down, Disney can sell Mickey Mouse ears. Netflix is still a pure-play streamer.
True. They are exposed.
And saturation. The U.S. market is mature. Growth here relies entirely on price hikes and that ad tier. Can they really double ad revenue as predicted? If a recession hits, the first thing companies cut is the ad budget. If that ad market tanks, Netflix's growth story takes a huge hit.
Those are valid points. But here is my rebuttal. I call it the pricing in argument.
Okay.
The stock has already seen a 30% year-to-date drop. The market isn't stupid. It knows about the lawsuit. It knows about the debt. That 30% drop tells me that the fear is already baked into the price. The bottom is likely in.
So you think the bad news is already discounted? It's like buying a house that needs a new roof. If the price is low enough, it's still a good deal.
I do. When everyone knows the bad news, it stops pushing the price down. And that leads us to the final verdict. So how do we grade this?
We've looked at the cash cannon, the IP fortress, the scary charts, and the lawsuit. Where do you land?
I have looked at the growth, the cash flow, the sentiment, and the risks. I am assigning Netflix a bullish score of 8 out of 10.
An 8 out of 10. That is confident.
It is. This is a multi-year hold thesis for me.
Walk me through the core argument. Why an 8 and not a 6?
It's simple. Netflix has already won the streaming war. They're generating $9 billion in free cash flow while everyone else is losing money or barely breaking even.
Right.
Now, they are using that victory to buy the spoils, which is the Warner IP. You combine that with the ad tier explosion, 94 million users, and that 17% revenue growth, it simply outweighs the risks.
So the thesis is they are too big to fail and rich enough to buy the solution to any problem they have.
Exactly. They are becoming the utility company for entertainment.
What's the catalyst we should be watching?
January 20, 2026, the earnings report. We need to see if that ad tier revenue is actually showing up. And looking further out, the 2026 content slate. We've got Bridgerton Season 4, we've got Narnia. The pipeline is full.
I agree on the cash flow strength. You cannot argue with $9 billion in free cash. But I'm going to advise caution on the entry. I'd want to see how this Paramount lawsuit clears up before I bet the house.
That is fair. Wait for the smoke to clear if you're risk averse. But if you're looking for growth, the train is leaving the station.
And that's a wrap on the analysis.
Yeah.
It's fascinating because even if the Warner deal fails, Netflix is still a cash machine.
Right. But if it succeeds, it becomes something we haven't seen before in media. It becomes the standard. That's the breakdown on Netflix.
Make sure to subscribe, like, and comment if you want us to cover your portfolio picks next. See you in the next one.